Yeah, thank you so much, Aaron. I appreciate you having me join in. Technology is wonderful, you know.
Uh,
Things have changed in this day and age, but we're fortunate to be able to do these kinds of things. You know, 30 years ago, this wouldn't have happened. So my name's Chris Tanner. I'm a business development manager at New Direction Trust Company. New Direction Trust offers self-directed retirement plans. And so in essence, what I do is I educate people and I let them know how they can use their retirement funds primarily to invest in alternative assets. And so it's interesting that you give me a call because we have an awful lot of people. The phones are lighting up right now, whether they're wanting to invest in real estate or invest in, gentlemen like you who are then in turn investing in real estate. But we're seeing a lot of activity right now. And so basically my job is to show people, how do we take money that's sitting in a retirement plan and put it into an investment that, you know, the typical brokerages and retirement plan companies are.
I'm going to unmute myself. Big fan of self-directed IRAs. I have about a third of our investors here at People's Capital Group self-direct their IRA into real estate. So, it's a great connection here that we have. We always team up with self-directed IRA providers. And in fact, a lot of our investors come through New Direction. New Direction Trust?
Trust, yeah, we actually changed our name. We used to be New Direction IRA, but yeah, New Direction Trust.
Excellent, excellent. So yeah, we've had a great experience working with your team there. And, we've worked with a lot of different IRA custodians. And I have to say, one of the things I like about your group is they're very fast to respond, which is very important when you're trying to move money into an asset,
Yeah, no doubt. And as you know, Aaron, you guys have deadlines, right? You have
Sure.
closings. It's not like we might need your money. You need, you have set, you got to have money when you get it. So yeah, we understand that. And we work very hard to meet those deadlines, assuming we have enough lead time, obviously, to make that happen. So yeah, we pride ourselves in trying to provide top level customer service.
Great, great. So let's go over the process of how someone can self-direct their IRA kind of from A to Z. How would someone do that?
So it's really kind of a three-step process. And so I always like to outline the basic 3 steps. So the first is that a self-directed IRA it's just an IRA. So it could be a Roth IRA, a SEP IRA, a traditional IRA. So really the first step is just opening up an account. It just happens to be that the accounts we open are all self-directed. So that's easy. That can just be done online. That's very quick. The second step, of course, we got to get money into the account. And so for a lot of people, that means we're going to do like a rollover or a transfer from an existing retirement plan. And Aaron, remind me, before we jump off, with the CARES Act, there's a unique way that people can move money that previously they wouldn't have been able to move, but we'll touch on that a little later. But then once the money is there, of course, it's just a matter of working with the investment provider and the client to fund that particular deal. And so the fact that it's self-directed, the client is the one who tells us what they want to invest in, and they give us the details. And once we have all the information we need, we'll go ahead and take that money that they've rolled over to us, and we'll place it with groups like yours, like People's Capital Group. So it's really a pretty straightforward process.
Yep, and that's what I love about it. It's very simple to explain. It's very simple for people to execute. And, it's something that I think it's misunderstood by a lot of financial advisors, by a lot of people that are in charge of, moving money around in the markets. Essentially, if you're looking to self-direct your IRA and you go to your financial advisor, you're kind of asking him, hey, can I move my business or some of my business elsewhere? And, it's amazing the responses we get from finance. No, that's illegal. No, that's too risky. You shouldn't do that. It's really a shame there that it's so misunderstood. What is it? How many trillion is in self-directed IRAs or in IRAs in general?
Well, what's interesting. So in the United States, there's 27 trillion. That's trillion with a T.
Jeez.
in retirement accounts. So that counts obviously IRAs and 401ks and things like that.
Mhm.
Now, self-directed makes up less than 3% of that. So what that means is basically 97% of everybody's retirement funds are all in the same thing,
Mhm.
publicly traded securities. So for the
Mhm.
most part, stocks, bonds, mutual funds. And so to your point, Aaron, uh, self-directed has different meaning
Mhm.
depending on who you're talking to. Uh, some of the more, I guess, traditional brokerages, they'll use the term self-directed in the sense that there's no financial planner helping you. You're picking your investments, but you're still only able to do publicly traded securities. So it's important if you really want to invest in private equity, like People's Capital's offering, that you find a custodian that can accommodate that kind of an investment.
Mhm.
And I have a
Absolutely.
question, Aaron, if that's
Sure.
okay.
Yeah.
Yeah, Chris, what are some of the reasons why people tell you they want to self-direct? And I also had another question. What are some of the reactions they give you after an investment or even during an investment as far as their satisfaction of the process?
Yeah, so it's a great question and it's very timely. So I'll use the example. I literally met with a couple of people today. In March of 2020 was their turning point. They saw their account, within a week go down by $80,000. And I think the way they described it is they just felt like they had absolutely no control. They just felt like, well, when the market goes down, I'm going down with it. If it goes up, it goes up. They didn't feel like they had much control. So probably the biggest thing I hear, Seth, is once somebody figures out that they can self-direct and they kind of figure out the process, it's the idea that they have so much more control over those funds, that they are, as opposed to picking when to buy and sell or what stock maybe to go into, they can get really selective and get into things that they have way more control over. And so that's the biggest thing we find, is that level of control. They're not just hoping the market stays up and, we don't have something like COVID hit and bam, we're down 30% pretty much overnight. And the thing is they have no control over that. They're just along for the ride. Whereas with the self-directed, I think you have quite a bit more control.
And do they tell you that they have a good experience with it, those that complete the process?
I think most people do. I think the reality is, at the end of the day, they're picking the investment. And so if the investment goes well, they tend to like us more, even though we're not necessarily in charge of the investment. Um, and if the investment doesn't go as well, they're not as happy with the process. But I think most people are satisfied once they just figure out, you mean I have the freedom to do this with my money? I don't have to put everything, all my eggs in one basket, so to speak. In general, they are happy and they like and appreciate that opportunity.
That's good to know.
Yeah.
And also, I see there's a question here. If you have any questions, please type them in the Q&A or the chat. And as we finish with Chris here, he can answer those questions. And so, Chris, I did want to go on to our next question here. By the way, everyone listening, we're going to talk with Chris till about 7:15. He's an IRA custodian, that if people jumping on here, and he's the IRA specialist. And then we're going to break into the real estate part, and Seth and I will talk about how we self-direct IRAs into real estate. But first, we're talking about the IRA end of it more so. And so, Chris, what does it cost to self-direct your IRA?
Yeah, it's a great question. Setting up an account usually is $30. And for the majority of our account holders, we charge an annual fee. And for the majority of our accounts, it's going to be $295. The other fee that we charge is what we call a transaction fee. So keep in mind that the investments that a lot of times we're working with, and Aaron, this, the paperwork that's involved, it's not like buying stock where you click a button and you own it. There's a lot more paperwork to go through. So we typically charge a $95 transaction fee, and that's when we actually move the money from the IRA over to folks like you at People's Capital and actually make the investment. So that's a pretty basic rundown. Small fee to get the account set up. let's just call it a $300 annual fee, and then $95 to just get the money placed. Once the money's placed, you're just going to have that annual fee for the most part. There might be some small fees, but there are distributions that happen depending on how those happen. But those are the typical fees that we see.
Right. And the way we like to structure our investments is it's a simple one-time transaction into an apartment building or a cash flowing piece of real estate. And then we pay cash flow checks back to the IRA custodian quarterly. And of course, a large check upon the refinance. And that's better for it keeps the cost in mind for our investors because they really have that one-time transaction fee or review fee, which we see with a lot of custodians, because at that point, there's some work involved. But for the most part, people are surprised at how inexpensive it is to self-direct your IRA. It really is quite affordable.
Yeah, I would say so. And the nice thing about our fees is they're very transparent.
Mm-hmm.
That's about as straightforward as it can get. So anyway, I agree. For the most part, compared to, I would say a lot of times retirement plans, you're looking at 1% as a ballpark. 401ks can be higher. We tend to be quite a bit less than that. But at the end of the day, if it gives you an opportunity to make a significant return with a better investment, sometimes those fees are pretty inconsequential.
Sure. And what are some of the restrictions? What are some of the things people cannot do with their self-directed IRA?
Yeah, glad you brought that up. There are some rules around that. Some of the biggest rules involve who you invest with. So as an example, you typically cannot use your IRA funds to invest in something that you personally already own or already control. And there are some family members as well. A lot of times it's direct lineal descendants. So like mom, dad, maybe sons, daughters. So as an example, if you have a son or daughter going to college, you want to buy a rental for them while they're in college. Unfortunately, you wouldn't be able to do that with your IRA. So the IRS has certain individuals that they say are not, allowed to benefit from that IRA. So cannot pay yourself a salary as a result of an investment through that IRA. And so, we actually like private equity deals like what People's Capital puts together because the odds of running into those kinds of problems are really very slim.
Sure.
Because you're handling everything. So the odds that they're doing much and can get into trouble is quite a bit less likely than when they buy real estate directly. So some common examples, and if someone's investing in real estate, they can't be in there doing what we call sweat equity. So
right.
They can't be doing the painting, ripping carpet out, that kind of stuff. So just some of the basic rules.
Oh, that's too bad. They can't rip out dirty carpet. Oh my gosh. Our investors love ripping out dirty carpet.
Right. Who wouldn't want to do that, right?
Oh yeah. No, that's obviously not at all what our investors do. They enjoy the benefits of real estate without ripping out the dirty carpet. That's where Seth and I come in. We're excellent carpet rippers outers.
Exactly.
Great stuff. All right, let me open up the Q&A here. Looks like we have a couple questions. Number one, Lenny asks, so essentially it is a Roth IRA that has money invested into real estate. And Lenny goes on to say, when you say you are in control of a self-directed IRA, what is different from the control of a Roth? I ask because I'm in control of what I invested in my Roth as well. So
that's a great question. So the biggest difference is if I have a Roth IRA, what I would call a traditional investment firm, you are limited in what you can invest in. Typically, it's going to be publicly traded securities. So if you were to go to the current custodian and say, hey, I want to buy this property on ABC Main Street and I want my IRA to own it, or I want to invest with People's Capital Group. It's a private placement investment. It's not a publicly traded company. Can I do that? More than likely, the answer is going to be no. So what the self-directed does is it opens you up to more investment opportunities. It doesn't limit you. You can still invest in publicly traded securities, but it does open you up to, I would say, more investment options. And when we say real estate investment, we really mean more direct real estate investment. So the IRA can actually own the real estate, or you can invest in a company that is then investing in real estate, like People's Capital Group.
Great, great. Okay, excellent, excellent. And Lenny went on to ask also, when you invest in self-directed, are you penalized for pulling out early before 59 and a half years old? And if so, what are those penalties?
Yeah, so the rules are the same for a self-directed account as they are for any retirement account. So those rules stay the same. So if you do pull it out before 59 and a half, there could be a penalty. But interestingly, I just want to mention this, is that as a result of the CARES Act, so the CARES Act was a law that was just signed into being this March, the IRS is giving us a little more leeway about accessing those retirement funds. So Lenny, if you happen to be impacted by coronavirus, and there's a whole slew of things that could encompass, the IRS will actually allow you to take money out, and that early withdrawal penalty doesn't apply as long as you've been impacted by that COVID-19. And I just wanted to mention real quickly, an aspect of that CARES Act, Aaron, we were talking earlier and you said, I know that you can pull out $100,000. And one of the cool things the IRS does is they say, if you recontribute that money within 3 years, we're not going to tax you on it. But here's one of the cool things. If you happen to have a 401k plan, and you might want to keep this in mind, because you may have had investors that thought, yeah, I want to use money and it's in my 401k.
Mm-hmm.
But if they're currently employed, a lot of times the employer doesn't allow that money to leave. They're stuck.
All right.
What changed now is that if there was a COVID-19 incident, that somehow somebody was impacted, they can pull $100,000.
Mm-hmm.
And as long as that money goes back into another retirement plan, it doesn't have to go back to the same 401k.
Mm-hmm.
So it could come over into a self-directed IRA. It's essentially works just like a rollover. And so there's this unique window until December where, I don't know, you might have had investors who wanted to invest and found out, hey, I can't touch that money right now. It's possible that that money might be available. And if nothing else, they can get it out of the 401k if they don't like the options, and maybe get it into an IRA where they have a little more control, a little more freedom as far as what they want to invest in. So I did want to just at least mention that, because it's, we got, 6 months basically, if that 5 months left, that might be a possibility.
Sure. That's great. So essentially you can, I think the tax burden of pulling from your IRA can be worked out over 3 years. Right.
Yep.
And as you were saying, and you can also repay that money back in over the 3-year period to avoid those taxes. Right. So as you're saying there, so that's great. So we have an investor actually now that's doing that, which is an excellent strategy. And, of course, talk to your accountant, talk to your financial advisor as long as they know self-directed IRAs, right? And they'll help guide you with that.
Totally. Absolutely. Yeah. Don't just call up and do it. I would definitely double check and make sure that you meet all the guidelines. It's the IRS, they have rules. So yeah, agreed. Yeah. Check with your CPA or a trusted advisor and make sure you're doing it correctly. And, but it is out there, just important to be aware, because it's kind of a unique opportunity.
Absolutely. Absolutely. Okay. And one more question here from Lenny. If I have a partner that owns a self-directed as well, are we able to combine our self-directed IRAs and jointly invest them into a real estate property?
That's a fantastic question. And the answer is yes. You can partner IRAs together. You can partner IRAs with yourself individually. There are different ways you can do that. The one thing to keep in mind is that when you partner, whatever that percentage ownership is, it's important to maintain the income and expenses in that same percentage. So for example, if your IRA owns half and somebody else's IRA owns half, just make sure that you keep the books real tight and everything is 50-50. So if there's an expense that comes up, half needs to come from one IRA, half needs to come from the other, and income's the same way. We want to make sure and share it in proportion to the ownership. But yeah, It can be done.
Excellent. Excellent. All right. So how can people reach you, Chris?
Very simple. They can, our website is the initials of our company. So they can go to www.aaspecialist.com NDTCO. So N like new, D like direction, T like trust, and then CO for company.com. They can also reach our 1-800 number. So that's 877-742-1270. And I can put that up in the chat box if you'd like.
Go ahead. Yes,
I can
please.
also, I can also throw my email up there. So if anybody does have any questions, I'm more than happy to answer them. And I welcome any questions. And so I'm typing that in as we speak.
All right. Lenny actually has one more question here. What benefits are there in opening a self-directed and funding it to invest into real estate rather than keeping it in my cash, not locked up in a self-directed and investing directly and not through self-directed account? What are the tax benefits? I mean, that's a great question for an accountant. It kind of depends on your income level. It depends on your tax burden. But I guess what are the benefits of an IRA is really the question there, instead of just investing cash.
Yeah, I would say, again, I think that's an individual decision. So one of the benefits we see is that folks that use Roth funds, they don't have to worry about the tax consequences. And so it's a little bit of a trade-off. You know, in real estate, when you invest personally, there is some benefit to writing off expenses and depreciation. And you guys very well know you have the accelerated depreciation. You have some nice tax benefits to investing personally you may not get on the IRA side. But I would say that's a conversation maybe with your accountant, and I could definitely look at someone's situation. And sometimes it makes sense to use an IRA, and sometimes it's maybe not in your best interest, quite honestly. And it kind of depends on, you know, your tax situation. So there are some deeper, more in the weeds questions that I think have to come to the surface.
Yeah, it's kind of complicated because I have so many tax write-offs from my real estate holdings. There's a mixed decision on if it's even a benefit for me to put money into my IRA. So it really depends on everyone's situation and what's best for your tax needs. All right, great, Chris. So thank you so much. Chris's contact information is in the chat there. And Chris, if you want to hang out for the rest of the presentation, that's fine, or not. It's up to you. We're going to jump on over to our presentation here. And Seth and I are going to talk about how we self-direct, help people self-direct their IRA into real estate and what that entails. And we're going to focus on how investors do that, how we've helped people together become real estate investors. Maybe they didn't have the time to look at hundreds of properties and manage the real estate like we do. Real estate's a very management intensive asset class, or maybe they didn't have the experience to do it confidently. So here at People's Capital Group, we help people do that. We do that together with them, and we've been doing this about 10 years, and we focus on the New Jersey market. So my name is Aaron Fragnito. I'm a co-owner of People's Capital Group. Our mission here is to transform personal finances and quality of life by creating passive income streams through real estate investments. That's our mission statement. And the Robert Kiyosaki said, author of Rich Dad, Poor Dad. If you haven't read the book, check it out. Rich Dad, Poor Dad, great book. It changed my life. The moment you make passive income and portfolio income a part of your life will change. So let's talk for a second about how we got started here. Why are Seth and I doing a presentation today about how to self-direct your IRA? Well, we've been helping people do this since 2013, self-direct their IRA into real estate to make better returns through cash flow and refinance equity plays as well. And it was Seth's realtor to get started. I started in this business around 2010, and Seth was buying properties for pennies on the dollar. And I said, I want to work with this guy. I want to learn from this guy. And he had, it was a really good partner. So we actually teamed up and bought a 6-unit together. And we ended up building up to about 100 units over the space of the last 10 years. But Seth, why don't you talk for a little bit about how you got started in the real estate industry? Hope you're muted there.
Oh, okay. Thank you, Aaron. All right. So, yeah, my name is Seth Martinez. I'm the other co-founder of People's Capital Group. There's 2 of us, and we met about 10 years ago. Our mission now, as Aaron said, is to help people invest in real estate. But I got started in a different way. I have a background in healthcare before I got into real estate 10 years ago. I had a healthcare business in Manhattan with my brother, and we started it in 2003, sold it in 2009. And for the next year or two, I was consulting for the new company, and I read the same book that Aaron read right around the same time, 2010. It's called Rich Dad, Poor Dad, and it really talks about how to look at money and how to look at assets versus liabilities, and also how to look at your time and where you want to spend your time and how you want your money to work for you. And real estate is one of the best ways to do that. And that's how we sort of started the company. So, but this webinar is mostly for people who want to get in real estate, who don't have the time, as Aaron said, or the experience to do it alone, or people who do own real estate and they just want to buy more and they no longer want to trade their time for more real estate. They'd rather trade their money and accumulate real estate and have that real estate producing income for them without having to trade off the time. So we focus here on helping people, again, invest in real estate without having to spend the time, and that means passive investments. And
Great,
as
Seth,
Aaron said, yeah, sure, go ahead. Yep.
Excellent. So yeah, absolutely. So together we've completed over 250 transactions. We own about a $10 million portfolio, and we have our in-house management company that allows us to really control the assets, and that's really our competitive edge. So our agenda for tonight, we're going to talk about, number one, why do people invest in apartment buildings in New Jersey? Why is that our preference after doing fix and flips and wholesales and buying single family homes and multifamily and dabbling in a lot of different types of real estate and making money in different ways? Why do we choose apartment buildings in New Jersey? Number two, why do people prefer a syndicated investing? This is when you pool capital together. This allows you to limit your risks. So we're going to talk about that and also buy into a larger property, the benefits of larger properties. Number three, why do people value PCG's service? So we're going to talk about how we've made a nice turnkey experience for people who are looking to self-direct their IRA into real estate. Maybe you're tired of the volatility of the stock market, or you are in a position where just looking to diversify and get something that's more resilient to the recession or to the market ups and downs that we are seeing now, as the market's quite volatile, really more volatile than it has been in years. And it's growing more and more volatile through the years. So we're going to do a quick COVID-19 market update here. We're going to talk about how the Corona has impacted the market. You know, we have single family homes, which were kind of on hold for a little bit, but now it looks like they are coming back around. And the North Jersey market, where we focus on, is hot right now, but that's a very cyclical part of the market. And Seth and I have fixed and flipped about 50 single family homes throughout New Jersey here with our business, but that's a part of the market that's a little hard to predict. We actually prefer apartment buildings because even through these tough times, we have collections up to 90% on our buildings, and that allows our buildings to cash flow through these tough times. And that's really a testament to the strength of, you know, high demand markets here in North Jersey, but also well managed buildings. And we also self-storage. That's a great place to be, but people are going to pay their rent before they pay their rent for their junk. And office and industrial is really a soft place right now. We don't see much demand for office space. Retail as well. You have online shopping, which is really a challenge for retail space there. And hospitality and senior housing is a good space, but essentially at this time, that's very saturated with a lot of institutionalized investments. So we really focus on apartment buildings. And these times have shown us that, you know, apartment buildings are an investment that continues to produce value and cash flow and tax benefits through these tough times. So a strategic way forward through the Corona right now, you know, how to plan strategically to invest during a pandemic, right? So you don't make a bad investment. As we were saying, something that people need a roof over their head. You don't want to buy the fanciest real estate. You don't want to buy the bottom of the rung either. You want to be right in the middle of the road properties. We're going to talk about why we focus on that, how we focus on that, the benefits our investors achieve by investing in Class B and C real estate. But the most important thing is that tonight you educate yourself and learn how to self-direct your IRA into real estate, learn why real estate's a strong asset class, and see if it might be a fit for your investment needs, but also learn that you need to work with experienced professionals anytime you're breaking into an asset class. Maybe you've owned real estate in the past, you realize how It can be a very management intensive asset, and you actually do quite better when you're working with professionals to manage the buildings day in and day out, and especially in a syndication situation where those professionals have equity in the building and therefore a reason to make sure all the projections are hit. In fact, we like to overshoot our projections and underpromise and over-deliver. We've done that time and time again in the past for our passive investors. Whenever you're considering an investment in any asset class, you want to take into your value, how much risk you're willing to accept. Okay, again, we focus on what we think is the least risky part of real estate, which is real estate that everyone can afford. Working class families, middle of the road, class C and class B real estate. See, real estate's put into 4 categories: A, B, C, and D. And quite frankly, you're better off right in the middle there, where you buy properties that people can afford to live in. In these tough times, people in class A real estate move down to class B and so on. Class D is hard to collect during these tough times. Class A gets hit hard as well. So we think the least amount of risk is with middle of the road apartment buildings. Location, location, location. We do like being within an hour of Manhattan. We see a lot of people moving out of the Manhattan, out of the boroughs of Manhattan, and moving into New Jersey now. And also the history of the market. You want to be in a market that holds demand consistently. You want to be in a market that holds demand through recession. And we feel New Jersey has shown that to be a great market through the years and continues to prove itself as a strong market. So why do investors like New Jersey? Well, there's a lot of wealth here. People earn high wages. Wages rose 3.9% in 2019, and rents also grew a lot in 2019 as well. Rent continues to grow even during this pandemic. We're buying a building right now, and the rent has grown $500 on the building in the time we're negotiating the transaction. So New Jersey is a highly skilled workforce, ranks number 1 in education, ranks number 3 in median household income. And the state is home to 20 Fortune 500 companies, number 1 in drugs and pharmaceuticals, number 2 in direct foreign investments. A lot of wealth here, a lot of activity, a lot of business going on, a huge demand to consistently live in New Jersey. That's what you want to keep your rent strong and your collection strong. We have a line out the door to lease our vacant units. The hardest part is finding a good opportunity. So continued here, people are looking for legal tax shelters and predictable investment returns. So as Chris was saying earlier, investors are looking at losing huge amounts of their investment portfolio during the stock market woes, up and down, up and down. So real estate really is a nice place to diversify, where it's a little more predictable. We're buying an apartment building, the cash flow is expected to be this, the refinance strategy is this, and it really makes a little bit more sense for a lot of people rather than investing in an index fund where you do lose control of your retirement account, which is not something you want to be doing if you're getting close to retirement time. So people are looking for low risk investments by spreading the rental income amongst many apartment units. The vacancies hinder us less. So what that means is if you own a 2-family property and you lose one of your tenants, you lose half of your income, and that's going to really hinder your ability to cover your costs and make a profit. If you have a 25-unit property and you lose one of your tenants, well, we're still able to cover our cost, pay our mortgage, and make a cash flow on the property. So vacancies hinder you a lot less the bigger the property. So bigger properties are safer investments. In addition to that, people want to invest in ideal New Jersey properties with easy commutes to New York City. And of course, we look for buildings within a 10 minutes of a train station that allows you to commute into Manhattan in less than an hour. So what we found, the most important part is the management of the real estate. Okay, well-managed New Jersey apartment buildings fare well in recessions. It's really all about how well you manage your real estate, how well you manage your tenants. A happy tenant equals a happy investor. We make sure to improve our buildings, improve our tenants' experience, and that allows our tenants to agree to rent increases and work with us on maintaining the property nicely. And of course, there's other benefits. There's tax benefits to owning real estate as well. And people really enjoy the diversification of being in a tangible local building and seeing their IRA or their 401k make a difference in a local inner city area, maybe an area they grew up around. And that's an added benefit of investing your IRA into New Jersey real estate. If you are local to the real estate, you don't have to go to the property, but it's nice to maybe drive by and see your investment improving that building and therefore improving the neighborhood and improving inner city areas here in New Jersey. So Of course, as we were saying, people want legal tax shelters, predictable investment returns to confidently fund important occasions in life. We have a 5, 10, 15-year investment strategy. Our investors have multiple exit options, but they can also choose to stay invested long-term, and that allows them to fund important occasions like college or vacation or putting a wedding as well. And we just got married last year, so that's a good $40,000 to $60,000 you want to have ready there. So always a good long-term investment that allows people to really plan for long-term occasions. Or you can invest a shorter term with us as well. We offer both those options to qualified investors. We'll go over that later on. So as I was saying, people want the low-risk investments by spreading out the rental income amongst many units, okay? By buying bigger buildings, we have less risk. Now, normally a $30,000 or $50,000 investment would not allow you to buy a 25-unit property. You'd be stuck buying a 2-unit property. But by syndicating, by pooling capital together, your IRA can, with a small investment, can own a large property, a safer investment. In addition to that, Seth and I personally guarantee the mortgage. Now, what that means is that Seth and I will sign our name personally on the mortgage. That means the mortgage survives through bankruptcies or foreclosure, anything like that. Of course, that would never happen. But in that case, the mortgage is personally guaranteed. So that is something that Seth and I, we are in it to win it. We make sure that these investments are going to perform it as targeted because we are personally guaranteeing the mortgage. And that's a huge amount of risk that we are taking off the investor's shoulders. And that allows us to not only get better terms on the mortgage and save on closing costs so our investors make better cash flow, but also it shows to our investors that we are committed to the investment, and it also allows our years of banking relationships to get very, very attractive banking terms. And the better banking terms you have, the better you can cash flow on the real estate. So Seth and I do that for our investors, and we focus on buying properties with easy commutes to New York City within an hour of Manhattan, 10 minutes to a train station that gets you to Manhattan in less than an hour. We focus on Newark, Patterson, and Passaic. We buy mismanaged apartment buildings. We improve the income on them. We lower our expenses, and that allows us to improve the value and the cash flow of the building. And so let's talk about why people prefer syndicated investing. So when you syndicate an investment, you pool capital together and buy it. That allows not only smaller investors to get into bigger buildings, but also we manage everything from A to Z. We have our own in-house management company, and that makes sure that we're going to be collecting the rent goals and also hitting our goals and our targets for the repositioning of the property. People like the idea of tapping into expert real estate knowledge and being lifted up above the pitfalls. And Seth and I have spent about 10 years learning this market, developing relationships with contractors and service providers so that we get things done very affordably for these buildings. A penny saved is a penny earned. The less we spend on renovating the units and managing the buildings, the more cash flow we're able to give back to our investors. So it's taken years to get these relationships in place with all of our contractors and service providers. But at the end of the day, our investors value their free time and have no interest in securing the complex financing through banks that Seth and I do to personally guarantee that mortgage. So the main benefit of syndicated investing is the management of it. You don't have to do anything from A to Z, but it's not like hiring a management company and hoping they do their best work. A syndicated investment where Seth and I are actually owners in the property with our investors, there is really an incentive for us to make sure our management company executes far better than any other management company out there. And we found that you really actually need to own your own management company to really get the results you're looking for. Because otherwise, if you ask a management company to renegotiate all the leases, find out ways to make more income on the property, lower the expenses on the property, improve the property for the lowest possible cost, and just manage collections and rent increases to a T, also do it for a very discounted property management fee, well, they're probably going to say thanks, but no thanks. We found that management companies are never going to take care of your baby the way you need to, so we developed our own management company to force equity into the building, produce better cash flow from the building by lowering our expenses and increasing our income. And this results in a tax-free refinance liquidity event every 4 years or so on our properties. We also have all of our tax prep done for our investors each year. Our investors get a K-1 tax form Our investors are owners of actual real estate. Each fund is created for one property, each LLC for one property, and every 3 to 5 years, we do a refinance that allows the investors to split up a large lump sum of capital, but also exit and get back their initial investment if that's their preference, or stay invested long-term, which is a better tax strategy. We'll invest up to $10,000 to find an opportunity, sometimes in a month in marketing. We'll look at 400 properties to find one. And we really take a lot of time and effort and due diligence to pick the best opportunity for our investors that's going to lead to the greatest chance of success through their investment, the greatest chance of cash flow and profits through the refinance. We have 10,000 investors in our network. We work with only a select few of those investors, though. We have about 30 investors in our pool that are qualified to invest, and about 20 more or so coming on. So you do have to get qualified to invest. And there's really a large amount of demand to invest in the North Jersey market because there's not a lot of syndications doing North Jersey. Most syndicators are raising capital here, but buying properties out of state, hiring a third-party management company, and hoping they do what they say they're going to do. We found that management companies often don't do what they say they're going to do. And we found that if we're going to put our name on the line and we're going to work with our investors' capital, we want to control that asset 100% day in and day out. And that makes sure that we hit our targets for our investments and our investors. So we've secured funding on over 250 properties, over $40 million, with a $10 million portfolio right now. And about 86 rental properties at this time. And as we were saying, we personally guarantee that bank loan, so we make sure we're hyper motivated to remain vigilant and hit those targets day in and day out on the property. And Seth, you want to talk a little bit about how we achieve those targets?
Sure. Thank you, Aaron. Okay, so why do people value People's Capital Group's service? And as it says here, aggressive calculating business model. And we like to set a high standard for everything we do. It's a tough business. You're dealing with a lot of people, and a lot of our clients, the people that invest with us, have tried it themselves in the past, and they didn't like the brutality necessarily of dealing with real estate. You're dealing with inspectors, you're dealing with tenants, you're dealing with contractors. Nonetheless, we want to set a high standard, be professional, and do everything properly, and in a sense be a perfectionist. So it starts with finding the deal. And as Aaron had mentioned, we spend roughly $10,000 a month in marketing for finding deals. They're needles in a haystack. Some of our great opportunities, apartment buildings, have come through our marketing. Some have come through just realtor relationships. So we work on those as well. And you never really know when your next deal or opportunity is going to come, and they usually tend to fill up fast once we get them, because they are great deals in the Northeast, in the New York City metropolitan market. And we look at, as it says here, roughly 400 properties a month. And we share the best ones with our clients, our investors. We'll sell, in some cases, the ones that we don't think meet those standards. So finding the deal is really the starting point. But the syndicating process allows us to buy these properties, as Aaron said, with qualified investors who we select into our investor community. Everybody goes through an interview process, but if they're approved and we think it's a good fit, we buy the properties. And one advantage for our clients is the risk is shifted to People's Capital Group, as Aaron had said as well, and that is because the mortgage is guaranteed by People's Capital Group, not by our investors. The ultimate goal, as it says here at the bottom, is passive income. And again, a lot of our clients come to us. They want to diversify. They have too much money in stocks, maybe 90%, even 100% in stocks and cash, and they want to diversify. We usually recommend a 1/3 of a portfolio to be in real estate, and then maybe 1/3 in stocks, 1/3 in cash and commodities. Everybody's a little different, but we do highly recommend everybody who's qualified to invest have at least 1/3 or 1/4 to 1/3 of their portfolio in real estate. Some people are over 50%. Okay, so let's go to the next slide here. And so once we find the deal, the next step is, and why people value our service is, again, because as a passive investor, they're taking advantage of these processes. And this is a 3 to 5 year process, but the goal and the next step here is to increase the value of the property. Now, all real estate will increase over time if it's fairly maintained. If it's not dilapidated, it will actually go up over time, and that's called appreciation. We call it natural appreciation. The other thing, though, that we bring to the table that our clients like is what we call forced appreciation or forced equity appreciation. So we want to take the natural appreciation, which is the market, which is roughly 2 to 3% a year, and we want to add to that as much appreciation as possible. And as it says here, the way we do this is by bringing our expertise and increasing the rents as leases come due and decreasing expenses as leases come due. And that's done through changing out utilities, whereby an old landlord, maybe a building that we buy, landlord is paying for heat or electric or all the utilities or part of the utilities. And when we buy these buildings and leases come due, we want to convert those to tenant responsibility because that reduces the expenses, increases the building value. So this is a lengthy process. It requires a lot of knowledge, a lot of skill, working with good contractors, and that's what we bring to the table. We have long-term relationships with contractors, and we share those, of course, with our clients, and they don't have to establish their own contractor relationships. And so contractors, screening tenants, having good relationships with the town, inspectors, things of that nature were necessary. And again, over 3 years or 5 years and even beyond, we want to increase the value of the property as much as possible and couple that with the natural appreciation. So you kind of get 2 for 1. And ultimately, when done right, you're looking at tax-free income because this is real estate, and real estate is very unique as an investment because it offers tax benefits that no other investment has. And again, another reason why people value our service, because as a passive investor, even though they're not doing any work, they can take advantage of all those benefits of real estate because they are owners in the building, even though they're not doing any active work. So let's go to the next slide. Okay, so just a little continuation here of how to get it done and how to be successful. This comes with a lot of experience, and as Aaron had said, having our own management company we feel gives us a competitive advantage over our competition. Some of our competition actually does have management companies. Most of them, you have to, it's hit or miss, but we believe our management company gives us a competitive edge because it's in-house. We can watch the numbers very closely. We can monitor things very closely. Our management company and our property managers have a stake in every asset. They have compensation based on performance, and that's been developed and refined over years. And it's a very nice benefit that we bring to the table and our investors share in. And that also includes contractor estimation. So when we go into a building, we know what the construction costs are going to be before we buy it. We've done analysis, we've done inspections, and we have a construction budget and a scope of work, and all of that is in escrow. And so we hit the ground running on day one, and we can start adding value on day one. As it also says here, we only manage our own properties. Our property management company does. We do have questions from time and interest from time where people want to, they see our results. We get very good results. As Aaron said, collection rates were close to 99, over 100% in some cases. Pre-coronavirus, we feel we're going to be back there shortly. And people see this and they want to take part in our management company, but we do turn that down. We tell them we only focus our management company on our own assets for ourselves and our investors, and we want to be laser focused and we want to get the top performance. Our management company is in business to maximize our assets and our real estate for ourselves and for our investors, and not to manage other properties. Even though it might be more profitable, we become more profitable as a company, and our investors become more profitable when we focus on just our own properties. And again, as it says here at the bottom, consistent cash flow, that's the end result. Okay, so as we wrap up an investments, as Aaron said, are 3 to 5 years. What happens? Well, we want to make it easy. We want to make the choice up to the investor, and they have 2 choices. They can stay in the investment for another 3 to 5 years, or they can exit. We ask for roughly a 6-month notice. If they stay for another 3 to 5 years, they take all their profits and they just keep their principal in. If they want to exit the investment, which most do not, they can, of course, take their profits and their principal. Okay, and then just lastly, the power of syndicated investing, we want to make it easy for people to invest in real estate. Of course, there is a qualification process. We do vet everybody. It has to be a good fit for us, and it has to be a good fit for them. And we want to understand your financial needs, your financial goals. If you don't have a financial blueprint, we try to give you one with a real estate as the way forward. We work with dozens of investors as well. It says here the minimum investment is $30,000, but again, there are some qualifications that go with that. And we'd love to hear more if you want to learn more and see if you qualify. So, Aaron, I'm going to hand it back to you.
Thank you, Seth. Excellent work. All right. So as Seth was explaining, that's the buy, renovate, refinance strategy, also known as the BRRRR on Bigger Pockets and out there on the internet. We were actually doing the buy, renovate, refinance strategy, the BRRRR, before it had a cool name that the millennials gave it, but now it has a cool name. So we're going to talk about a couple buy, renovate, refinance strategies here. These are some case studies on 2 different properties that we purchased, one we refinanced and one we sold. So this is a smaller property. It's a 5-unit property, but it's a good example of buying in the right area and watching the value go up over time with just really a small renovation cost as well. See, we prefer to buy buildings that are in up-and-coming areas. Maybe it's near an opportunity zone. Maybe it's near Rutgers University in downtown Newark, like this building was. We're buying a lot around opportunity zones right now, and there's a huge demand and a huge amount of energy going into those markets, and we focus on buying around the cranes in the air, not being the cranes in the air, but buying around them. So this is a great example of that. This is a 5-unit near Rutgers University in Newark, New Jersey. We bought it for $110,000. They were asking $130,000. We bought this in 2013. So we were able to capture $20,000 in equity off the bat. And that's our job, to work with wholesalers or realtors or worn out landlords and do tons of marketing and work years of relationships to bring our investors the very best opportunities. In this case, we were able to get about 15 to 20% off the list price. We put another $30,000 into the building. Now, keep in mind, that's not a large investment for real estate renovation for a 5-unit property. It's a very light renovation. You know, it's about $6,000 per unit in this case, and that's how we like it. We really try not to reinvent the wheel here. The more you're swinging hammers, the more you need permits or architectural drawings and all those, all that red tape. The more you have to go through that, the more risk you have on an investment. So our goal is to eliminate the risk and build a reward for our investors. So in this case, we kept our renovation costs low. We bought the property for a discounted price. You make your money when you buy. And that allowed us to refinance just 1 year later at a price for $310,000, 1 year later, after a $30,000 renovation. And that allowed us to pull out our entire initial investment. Our investor made back his initial investment plus some profit. And then we resorted to a 80-20 split in that case. Usually it's more closer to the other way around, with the investor owning the lion's share. But in this case, we had a different agreement with the investor. And they were able to make back their entire initial investment in a year, and then they continue to cash flow to today, to continue to get tax benefits every year. We refinanced again in 2017 and split up another large lump sum of capital. So real estate, if it's managed properly, if it's in the right area, if you buy for the right price and keep your costs low, as we do here at PCG, we're able to pull equity from that property, harvest the equity growth over time, not harvest too much equity. You don't want to over leverage, but you do want to be able to harvest that equity as it grows. And that allows us to continue to cash flow on the real estate, continue to get the tax write-offs, have a safe amount of debt, but also harvest that equity growth, which is tax-free liquidity event, which Seth had just explained, because that's debt. It's debt that our tenants are going to pay down for years. It's good debt. It's low interest debt, but it's debt. So therefore, when we disperse that out to our passive investors, that refinance capital, as long as you're not exiting the investment, is income tax free. And that's really the greatest benefit here. It's a tax strategy. That's what we have. It's a great tax strategy. So here's a 25 unit in Paulsboro, New Jersey. Now, this was a building we bought and sold. One of the challenges we had that we recognize, a building more than an hour away is hard to manage. So really we only focus on buildings now within an hour of our office to make sure we can manage it properly. And there's also so much opportunity within an hour of Berkeley Heights. We focus on Patterson and Newark and Plainfield and Jersey City and Elizabeth, great markets out there up here in North Jersey. I see a couple questions came in. Thanks. Please keep submitting your questions. I'm going to answer all the questions at the end. So keep submitting your questions as we go along. So we bought this property for $1,075,000. They were asking $1.2 million, and we were able to negotiate about $125,000 off the list price. So that's our job, is to go through hundreds of properties, negotiate hard with the sellers, have good relationships, and get these properties for great prices. We went and secured a bank loan for 75% of the purchase price. Now we really get bank loans for more like 70%, but we acquired a 4.5% interest rate. This was back in 2014. So now we're getting interest rates sub 3.8. I think we're around 3.75 or so on our most recent purchase. And our private investors brought in $100,000 each. In this case, we did a 60-40 split. It's not always that clean with investors bringing in $100,000 each, 4 investors at $100,000. Sometimes we have an investor at $300,000, another investor at $300,000. So we have small investors, we have big investors, we have multi-millionaires we work with. We also have small realtors getting, investors getting started. Maybe they're a realtor that just had a big closing and they're considered a sophisticated investor, meaning they understand the investment and have the minimum investment amount plus some. And so we really pride ourselves on working with small and big investors. But in this case, we had 4 medium to large investors come in with $100,000 each. We did a 60-40 split. And in 2017, we sold the building for a nice profit of 26% for $1.35 million. And our investors were able to make about 11% cash on cash return when annualized on this building. Okay, so we bought, renovated, and resold the building, and our investors walked away with a nice solid 11% cash on cash return. I think we projected about a 9.5% cash on cash return, and we were able to over hit that target. And that is what we always aim to do, is under promise and over deliver. So let's talk about investing with your IRA, self-directing your IRA into real estate. As we spoke about at the beginning of this presentation for about 15 minutes with Chris from New Direction. You can self-direct your IRA with an IRA custodian, such as New Direction, and that'll allow you to move it to that IRA custodian and then move it into an asset that's not prohibited. And your IRA custodian will guide you a little bit on, if the transaction is prohibited or not. Now, remember, your IRA custodian is not going to underwrite the property and be like, yeah, this is a great property. It's near an opportunity zone with rents below market value, and the operators have a 10-year track record. Or, vice versa. No, it's not a good opportunity. The operators are rookies. Your IRA custodian isn't there to underwrite the opportunity necessarily and tell you if it's a good investment or not, but your IRA custodian will tell you if it's prohibited or not to invest in that opportunity. So once you select your IRA custodian, find the one that's the right fit for you, you would self-direct to that IRA custodian and then select the correct investment. You could move it into a couple investments. You can even start an LLC that's owned by your IRA and managed by you. That's called a checkbook IRA LLC account. It's a little more complex, but in that case, you can move it into an LLC that's owned by your IRA and managed by you. Now, this is not a way to pull from your IRA early. This is not a way to pay yourself a management fee and beat the tax man, but it is a way to say you want to flip a property and really see what it's like to flip a property, and you're going to need money readily. You're going to need to pay your contractors and your service providers regularly. So having your money with your IRA custodian might be difficult because it takes a few business days to get a check. So if you're going to flip a property with your IRA, you want to maybe look into starting an LLC account that's owned by your IRA and managed by you, and that's a checkbook IRA LLC account. You don't have to take that extra step, but some investors prefer that. Really, if you're investing in a property, the People's Capital Group, the simple and smartest thing to do is just move it to your IRA custodian, and then your IRA custodian will review the operating agreement, review the offering memorandum for whatever private offering we have out to our qualified investors at that time. And they will review that to make sure it's not a prohibited transaction. And you better bet we have an operating agreement that allows people to self-direct their IRA into real estate. Our operating agreement is precisely made just for that, because about a third of our investors are self-directed IRA investors. We're a great fit for IRA investors because we're a long-term solution. We also have short-term exit options, but you can also invest with us indefinitely, as we plan on doing refinance at year 4, a refinance by year 8, and by that time our investors have made back their entire initial investment plus some, and then of course we go on to refinance around year 12 and look to do a 1031 tax deference around year 15 or so, sell the building, defer all capital gains tax, trade into a bigger building. And as you can see, that would allow your initial investment to, if it's invested in a $3 million building down the road, you know, we get all the benefits of that building, cash flow, refinance capital, and then move into a bigger building over time. So it's called the 1031 tax deference. It's a great way to build your investment over time. It's our long-term strategy here at People's Capital Group. And other syndications really have the strategy of buying and selling a property. Nothing wrong with that, but we think the value of real estate is to buy and refinance a number of times, then sell to a 1031 tax deference. Most syndications just buy and sell a property around year 3 to 5 and don't 1031 into another property. They just split up the profits. That's a good strategy to make profits, but it's not a great tax strategy. So we have a good tax strategy long-term here at People's Capital Group, and a good long-term strategy to build your investment in a high-demand market. Okay, we try to make tax time very easy as well, with K-1s filed and sent out quickly to our qualified investors. So we're going to go over a couple quick case studies here, and then we'll wrap up for the evening. So here's 3 types of investors we work with quite often. The first one would be considered a high-income investor or an accredited investor. Okay, an accredited investor is someone that owns has $1 million in net worth, not including their primary residence, or has a $250,000 a year individual income, or $300,000 a year income, including their spouse, and has the expectations to make that next year. Okay, if you don't make any of those financial criteria, you probably fall into a sophisticated investor, which I'll explain in the next slide. But an accredited investor is generally a high net worth individual who has large stock portfolios that gets stock dividends. We feel real estate offers a higher quarterly income through cash flow. And also dividends are taxed, where tax depreciation allows you to write off your cash flow. Now, if you are investing with your IRA, taxes are a bit of a wash through. We feel that the stock market's less predictable long-term, where well-managed apartment buildings in the North Jersey market by a train station that will allow you to get to Manhattan in less than an hour, that's a more predictable investment. The returns are going to be a little more predictable, the strategy is more predictable, and we control the asset with our management company. So therefore, we can control more variables in the equation, and that allows it to be a more predictable, more recession resilient investment, where being invested heavily in the stock market is very recession vulnerable. I see more questions popping up. Keep putting up your questions there. We'll answer them at the end. Here's an active real estate investor. Okay, we work with a lot of active investors that are running around managing their own properties. Maybe they're flipping houses and they've come out of a big flip, and now they're looking to put some capital to work passively. And they find that actually investing passively in a property with People's Capital Group actually earns them roughly the same returns they're earning being the active owner of a property. Right? And as an active owner, you have to personally guarantee the mortgage. You have to manage the buildings or manage the management company. You have to work with your accountant at tax time to make sure all the bookkeeping and tax filing is done properly. At People's Capital Group, that's all taken care of. So it's a completely passive investment where the investor can make similar returns to what he was making while being an active investor and taking all the risk and putting all the time in. But by being a passive investor, they invest into a bigger building. They get the benefits of a bigger building. It's a safer building. It makes stronger returns over time. And of course, tax time and other, all the management intensive end of owning and managing real estate is taken care of by People's Capital Group. So they get to enjoy the benefits of real estate without doing the work. Okay, and finally, an IRA investor. So this is what we're talking about tonight. Is we are saying about 1/3 of our investors self-direct their IRA into real estate. And we are set up perfectly for IRA investors. So we love IRA investors and they love us. And we work with an There's no brokers that we work with, so there's no fees coming in. We don't charge asset management fees like a lot of other IRA brokers might charge. We allow people to, again, get out of the volatility of the stock market, get into a more recession resilient asset, a little more predictable long-term returns. And people like that. Your IRA, your retirement account needs to be predictable, needs to be something that when you need it, you need to know it's there. And also you want the tangibility of owning well-managed, high-demand real estate is very satisfying for a lot of investors as well, especially if you're local enough to drive out to the property and take a look at it. If you are local to our properties and you know about Newark, New Jersey, or Paterson, New Jersey, or Plainfield, or Jersey City, or Elizabeth, then you might think, yeah, I'd like to invest in the right areas of those markets, make good returns in those markets, but also see my money actually make a difference, right? We invested in downtown Newark 10 years ago. People said, oh, why are you investing in Newark? They have crime and bad schools. Well, we made millions of dollars investing in downtown Newark and around Rutgers University because those were markets that were a great return on investment where you got a lot of real estate for your dollar back then. Now, good luck in downtown Newark. It's very expensive. But by getting in at the right time, by recognizing when the market's growing, when those cranes are in the air, when those businesses are coming in, and you see the markets changing, you see the values improving, getting in on that ground floor, but also seeing your IRA actually make a difference in your local community is very, very important. So a lot of our IRA investors really enjoy seeing their IRA make a tangible difference in inner city areas. So folks, that's about it for the evening here. Here's a number of investors that have invested time and time again with us. Most of our investors are repeat investors because we underpromise and overdeliver. So whether you're looking to self-direct your IRA or you're looking to simply move some capital from the stock market or maybe out of a real estate investment into a passive investment, then People's Capital Group may be a great option for you. Here at People's Capital Group, as we were saying, we've been doing this 10 years. And what we see most of the time is that a lot of people stand on the sidelines and learn about what we do and learn about real estate. Maybe they go to some boot camp or pay a guru too much money, but we don't sell boot camps or the education. We just focus on working with passive investors and helping them together invest in high demand markets here in New Jersey, professionally managed buildings that produce consistent cash flow, wealth growth, and tax benefits over time. If that sounds like a fit for your portfolio, then do not stand on the sidelines. We see a lot of people do that, and then they come back around and say, oh, is the opportunity available? We say no, because it's hard to find a good opportunity. So right now we do have an opportunity out to our private investors. It's filling up very, very, very quickly. And the way to get qualified is to go to peoplescapitalgroup.com. And I'll put this in the chat as well, but go to peoplescapitalgroup.com right now and click the button that says apply to invest or apply to qualify. And if you aren't sure if you qualify, go to our website, peoplescapitalgroup.com anyway, fill out the application, and we're going to get back to you and we'll set up a call. If you are qualified or close to qualifying, then we will reach out to you and you can set up a call with me to kind of talk more about the process of getting invested, what that looks like, what the experience is going to be. And we'll talk about an actual opportunity that we're putting out to our private qualified investors right now. But it all starts with going to peoplescapitalgroup.com, filling out that qualification form. If you don't take action now, the opportunities will not be around for much longer. So go to our website, take a look, learn more. We have podcasts there and webinars. I'm going to go ahead and I'm going to put in the chat our website there. I'm also going to look at the Q&A here. Okay. So, okay, Lenny asked, do you charge any fees to invest in your property? Great question, Lenny. So the answer is no, we do not charge an asset management fee. We don't believe in getting paid just for raising a large amount of capital. We believe in getting paid when we do our job right. That means we get paid when we create positive cash flow, and the investors get positive cash flow. So do we. We get paid when we achieve our target for the refinance, and there's a nice liquidity event at the refinance. So we are a performance-based company. Seth and I get paid as we complete our targets and hit our targets, and our management company charges a very discounted property management fee, cheaper than your average management company, so that allows even better returns to our investors. And also, as we were saying, we don't do any asset management fee or exit fees upon the refinance or anything like that. So where we do not like fee-based businesses. Also, the second question from Lenny is, you mentioned year 15 looking to do a 1031 exchange. What are your views, concerns about Joe Biden's plan in regards to 1031 tax exchange? Well, politicians have been saying they're going to take away the 1031 for years. This is not a new talking point. Generally, there's a platform that says, hey, we're going to punish the rich and bring it all to the poor. I think it's a lot of talk. Listen, if laws change on the 1031, then first of all, there's going to be a ton of pushback against that. It might be temporary, when a more business-friendly administration got back into office, then it might change back. Or listen, we don't have to do the 1031. It's a strong asset. If the 1031 is taken away, then we simply might sell the building or might hold on to the building indefinitely. But the bottom line is it's a strong assets that we own that produce consistent value and cash flow. So if the laws change on 1031s, it's not the end of the world. We can always sell the building. We can always hold on to the building long term. There's lots of other options, but I don't really see that going away. I hope it does not. I think it's a great tax strategy, and I think it's something that helps improves our economy as well. It helps us build more buildings and create more jobs. All right, so what I'm going to do here, that's about it for now. I don't see any other questions. I'm going to put in the chat our website here where you can actually fill out a form to qualify on our website, peoplescapitalgroup.com. And as I was saying, if you're not sure if you're qualified or not, take a look at the website, fill out the application, and we'll get back to you. And if you are qualified to invest, we can start working together on a property if you feel that's a fit for you. That's about it for today. I hope everyone enjoyed the presentation. My name's Aaron Fragnito. Enjoy your evening, and good luck.